You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that funky tune means it's time once again for the funkiest show on the network, at least the one with the funkiest tune, of course, TWIFO, This Week in Futures Options. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-scintillating Options Insider Radio Network. And, of course, if you like TWIFO, we got a lot of it for you there in the old archives. Just head on over theoptionsinsider.com, click on This Week in Futures Options or just TWIFO, the right-hand corner there in the call-out, and you got all the archives there before you. Of course, you can always subscribe, iTunes, TuneIn, Stitcher, wherever you get your favorite stuff, Google Play, iHeartRadio, etc., so on and so forth. If you want it all, though, if you want the full enchilada of the Options Insider Radio Network, go out, grab our radio network feed if you're not already listening to this show via that feed. I know a lot of you guys are, but if you haven't gotten the full enchilada yet, go grab it. It's a lot of content, but I trust me, it is worth it. And, of course, however you listen, via our app, even available in all the major app stores, or even if you can join us live every Friday, 3 p.m. Central, 4 p.m. Eastern. Even though, based on some of your feedback, maybe we will move that a little bit earlier for you guys going forward. But if you can join us live right now, 3 p.m. Central, 4 p.m. Eastern, via Mixlr, MIXLR. We'd love to see you folks in there. And you can ask us your questions, your comments, give us your pearls of wisdom, and all of that other fun stuff. And I'm joined, as always, on the old TWIFO program by my cohort, my partner in crime, the yin to my yang, the maestro, the major domo of all things crude this week, Mr., and I mean that in many senses of the word, Mr. Nick Howard, the founder of Bantix Technologies and the creator of a little platform we like to use around here called QuickStrike. Nick, welcome back to TWIFO This Week in Futures Options.
Hey man, I just was listening to the music sort of with a new ear today, and I think I noticed some undertones of beatboxing there as well. So I think take some time and listen to that closing, and you might see some kind of guttural beatboxing in there. Or maybe it's just my mood for the week that I'm hearing it that way.
Guttural beatboxing, maybe the first we've ever talked about that on the Twifo show. All things guttural and beatboxing. Let's get into it, Nick. I thought for this show is appropriate. Let's just do all dairy themed episode and maybe some lean hogs. What do you think?
Yeah, sounds good. I don't think there was much going on this week other than those lighter commodities. So yeah, let's jump right in.
Let's get into it. Starting off in the fluid milk report. No, of course, I'm just kidding. This week was all things crude, all things WTI and all the variants therein, Brent, USO, OIV, OVX, all that fun stuff. Everyone and their mother, if you were watching a commodity this week, chances are you were probably watching crude. And what a story it was. It was an interesting one. A lot of will they, won't they, if you've been watching this product for any length of time, it's been a long dance around whether or not OPEC will actually finally get together and pull the trigger on a production cut. Of course, that's what's necessary to really stem this supply glut we've had in crude for the better part of the last year or two and really turn prices around. They've been, in the past, they've shown a reluctance, shall we say, to do that for a variety of reasons. It seems like they finally pulled the trigger this week, even though on Tuesday things were selling off because it seemed like the Saudis and some others probably weren't on board, or there are going to be some issues with Iran there. And the last minute, they managed to pull it together, and they announced a cut. And the cut they announced is going to be bringing it down from they're currently producing 33.7 million barrels down to 32.5, so a 1.2 million barrel per day cut. Doesn't sound like a lot, but when you're talking crude, listeners, that is a lot. Of course, a lot has to be factored in to make that happen. Russia has to play ball. A lot of other nations have to play ball. But as a result, we saw crude kind of go off to the races earlier on Wednesday after this. And that kind of a little bit of vacillation afterwards with net on the week. And again, this is This Week in Futures Options, so we're looking back a week. Actually, it's been a couple of weeks since we've done a show. Of course, off for the Thanksgiving holiday last week. And net on the week, only up about 5.5 handles out there in WTI. So still a good run, still about 12%. So I use only in quotes, but still an aggressive move out there in crude. And as you might expect, a lot of the commensurate moves we saw that were kind of interesting. Of course, when you're moving this far up the chart here, up the skew graph, we've said before, the near-term calls are kind of big, but in general, calls are lower from an applied volatility perspective than puts out there in WTI. So you'd expect some reduction in volatility as we move up, and this time we gapped up, so we kind of saw that coming off pretty aggressively. We saw at the money volatility, depending on where you're looking on the term structure, off many, many points, shall we say, 8 to 10, with some of those front contracts that going off substantially. Again, front month, not really a gamma story, or not really a vol story, more of a gamma story, but still, you're talking 10 or so points on most of the contracts out there, a little less, a little more, depending on where you're looking, which is an aggressive vol apocalypse, depending on how, and that's, of course, a lot of that coming off the tail end of a huge spike earlier in the week going into the event, when it seemed like it wasn't going to get done. We saw a lot of measures out there of crude vol like OIV and OVX spiking to near 60, which if you've been following those indices for a while, they've been hovering in the mid 30s to low 40s for some time. So gapping up that far, that showed there was a lot of concern about this event, whether it was actually going to actually play out the way everyone thought. And then, of course, once it did happen, we saw vol coming off aggressively again, why we see that massive sell-off later on there in the week. And, of course, when you're looking at a week that's as active as this, you're going to see crude is typically front month heavy anyway, and we saw that playing out again this week with nearly 60% of all the paper, and there's a lot of paper out there this week. Open interest up nearly a quarter, up about 22, almost 23%. So that's already an active product, then just lighten it up on top of that. So very, very active this week, and nearly 60% of that coming in all things front month, so Jan there, which is interesting. And if you're asking yourself, you say, what contract was it? What contract could possibly dominate a week that is so heavy, so fraught with crude headlines and crude activity? And yourself would respond, and quite correctly, it was those Jan 60s. Those things There's not many other words in this. Wow. a lot of those bad boys going up this week. Number one with a huge bullet and an exclamation point and a bazooka backing it up. About 129, almost 130,000 total of those going up this week. And interestingly enough, the lion's share of those going up on Tuesday when there was a lot of concern about what was happening with that deal, and then Wednesday when the rally was going to happen. Most of that opening also, which is very interesting. So yeah, of that about 130,000 or so, we saw 67,000 on Tuesday and another 31,000 on Wednesday. So about 98,000 of that, about 130, coming up in those 2 days. So a huge aggressive spurt for that 60 strike. I believe we have a question a little later. It's going to dovetail on that a little bit, but still just a huge amount of action. We haven't seen crude flirting with a 60 handle in a long time. So it'll be very interesting to see how this plays out. Number two, also in any given week would have been number one with a bullet, but this week it just squeaks in at number two it was the Jan 55 calls with about 50,000 less contracts, about 78, almost 79,000 going up on that strike. And again, a lot of that opening and a lot of that primarily on mostly on Wednesday this time, not as much on Tuesday. Kind of interesting that the 60s were so heavy on Tuesday. We think a lot of it would come on Wednesday, but still, about 34,000 of that 78, so not close to half. Coming up on Wednesday, and the rest kind of evenly scattered throughout the week. And then people saying, well, what about the puts? Was there no put love this week? There was some put love. You got to go a little bit farther down the strike chain to find it. It was the Jan 40s to the tune of 58,000. Those bad boys lighting it up. So a distant third. Again, that'd probably be number one any other week. But this week, so much lighting it up. The puts couldn't really hold a candle to the calls. Of that 58,000, about 19,000 coming on Tuesday and about 26,000 coming on Wednesday. Now, interestingly enough, compared to the calls, there was some opening, obviously, but not as much opening as there was on the call strike. So just a lot of interest there across the board. Nick, this is kind of what we've been talking about in crude for a while. For a while there, it's been this will they, won't they dance. For a while there was the 40 to 50 strike. Then it seemed like maybe it was 45, 55. Now it seems maybe, who knows, maybe the new upper band is the 60 strike, given all this love on that strike. But I know you've been watching crude a lot this week. I know you've been talking. A lot of outlets have been picking your brain this week, the Journal and others, about what's been going on that 60 strike and elsewhere. So I know it's been just all crude all the time, even more crude than your normal week is, Nick. So give our listeners some thoughts on what really caught your eye and just the sea of crude activity this week.
Yeah, I mean, you touched on a lot of it, but I think it's important to sort of reiterate some of the pure numbers here that we're looking at, right? So the 60 call was really the most active. But as you mentioned, I mean, of that 130 almost that traded at this point, we had 87,000 were opening. So, I mean, you're talking about some really real big speculation going on the upside there. So that was the topic that was really kind of pushing the top of the news envelope all week, was that 60 strike, and really the focus on that going forward. So just a ton happened there. We had a little bit of profit taking on Thursday afterward. It'll be interesting to see that number today. That 60 strike, it tapered off a little bit down to like the 4,000 range. The doubles traded more today than the 60, but that starts to make sense. We start to get to a little bit more of a reasonable range. Just having come from the floor and watching things move like this, and having speculation in terms of price movement and direction and stuff, this is a really interesting example of event volatility, right? Because if you go and take a look, I tweeted out and you retweeted it a little while ago, the term structure of the volatility. Typically when we start to roll towards, let's focus on the January contract here for a little bit. So we'll come back to the volume and open interest and stuff like that. But we'll just talk about the vol and what's kind of happened over the course of this. Course this week. So we're obviously down a great deal, and part of it is rolling up the term structure because we did have a price movement, but also there was a pretty good annihilation of volatility across the board. So if we go to the March contract, a week ago, that thing was 45 vol. Now it's just over 35 vol. So you're talking about a big shift. So a lot of that speculation around the OPEC meeting was just sucked the life out of what was going on. So I think that people that probably had some vol or had some gamma, I want to try to at some point get some attribution metrics in here to see, whether that movement with the delta that you got from your gamma, whether that got covered by whether that covered the volatility that got crushed in front of you. So with that said, what we're typically seeing as you move towards expiration, we see that front month volatility sort of creep up, right? We always sort of see it pull the vol term structure up, so it looks like you're holding a rope and it's kind of sloping down. But in this case, you just see that the thing got jammed down pretty good. So just taking a lot of the wind out of the WTI sale. So it'll be interesting. Like you said, we sort of have. We've been bounded. The 40 strike is still sort of the heavy strike on the downside, and there was a lot of activity in that as well this week. It's probably overshadowed by all the upside activity, but it'll be interesting to see. I didn't, as the week sort of played on, it didn't feel like it was going to trade too much higher. I mean, all those 60 calls, like, I'm always curious without actually seeing who's trading them or what's trading them. Is it paper initiating a sale saying we can't go much higher than this, or is it people, right? Because there are people who are going to speculate and say I'm going to sell it because I think it's an upside, or other people go I'm going to buy that because I think it's a movement up there. So, and that kind of plays into one of the questions that we want to talk about a little bit later on. But obviously the Jan. I think we have to go this time that people were thinking that this is the place we're going to go moving forward. Now, let's remind ourselves that the January contract only has a couple weeks left, right? So what are we looking at? We're looking at we have 13 days as of right now. So we have some room for movement on the upside, just if we're looking at it from what people are trading standpoint. But it'll be interesting to see how much more we can creep up. And I think what you're going to see, unless we get a sharp move up, I don't think we're going to see any big volatility moves like we saw up leading into this meeting. So we mentioned the January contract. So let's talk about a few things that kind of catch our eye there. So we look at the overall. If you're on the This Week in Options report, TWIO, whatever you're doing, cmegroup.com/TWIO, all lowercase. If you're out there and taking a look, you're seeing that the put call ratio on the volume this week, it was dominated by the calls. But what's interesting to me there, if you go on down to the March contract, LOH7, you see that contract was dominated by puts, and the next with the April as well. Not so much April, but there was quite a bit of, 217,000 contracts that traded in the March, but most of those were puts. So it looks like, as much as there was some short-term upside speculation, there was definitely some downside speculation as well, because in that March contract, the puts dwarfed the call activity. 48,000 in the 50 puts, 31,000 in the 47 puts, even 14,000 in the 40 puts. So a lot of activity on the downside. So I think that, as much as people think that there was some chance for movement upside, there was still a lot of buyers in those ranges, because as we've seen on all of these rallies, they've all kind of been, I don't know if the right term is false rallies or fades or whatever. So we've gotten a push, but then we've sort of trickled back down. So if you're getting those puts at a lower volatility and you think we're going to move, and people are buying those thinking we're going to move back down towards those, there's, it looks like we might be able to start looking at what kind of range that we're establishing for ourselves again. And if I look at the open interest on the January contract, for starters anyway, we could see that we have the max OI on the downside. It's the 35 strike with the 40 being very close, and the max OI obviously now after this week is the 60 strike, but with the 55 being very close. So again, I think we have sort of this, with these ranges that we've been having, it's not crazy to say we have like a 40 to 55 range in the crude, because we moved so much. We had $3.50 that we moved yesterday. So you're talking about some real decent activity going on there. Now, if I switch over to the March contract and see where we're bounded over there in terms of max OI, our max OI is the 40 strike, and again, our max OI is the 60 strike. So I think, again, we kind of have all this event volatility out of the market. We're sort of established ourselves 40 to 60 as the big range, okay? And then 45 to 55 is the next range. And one thing that we could look at that's nice and available, and it's also available for free on the CME Group website, is the vol-to-vol expected range. So if we go out to the March contract and take a look at what the one standard deviation is out for a March contract that expires 75 days from now, one standard deviation basically encompasses the 40 from the 45 strike all the way up to like the 62 strike. So, that is sort of, a reasonable range that they're looking for in that period of time for that March contract. So now as you start to think of trading opportunities, given we've had this event come out of there, you can start to see where you might pick some strikes to sell or strangles to sell, stuff like that. So, as much as we look at the front month, we have to also be cognizant of what's going on because in the other months, because the big open interest months outside of January are the February, the March, and then the June contract, and also the December contract. And I was playing around, looking around on the June and Dece, and I always try to look at the big open interest contracts out there. The June, there was 25,000 contracts that traded in the 60 strike out there, 25,000 that traded in the 58, 18 in the 55, 13 in the 53. There was 12,000 in the 65. So you had a range in the June from 50 all the way out to 75. And a lot of that was opening on the upside. So I think, maybe there was the short-term speculation for an upside move. There's this midterm March speculation for maybe we're going to trade down a bit before we trade back up while people figure out what's going to happen. And then long-term in the June contract, we're looking at some really big activity on the calls as well. And if we go look at the December contract, even that contract was dominated by calls as well, with another 86, 8,700 in the 60 strike, 7,500 in the 65 strike, 7,000 in the 55 strike, even 6,000 in the 75 strike. So, long term from the options activity, and again, based on those trades, I'm going to say that people are speculating that there's a movement up, right? Not just people selling, saying this is as high as we can go. But if we look at kind of midterm, I think a trading range, and then long term we have an increased price range. So it'll be interesting to see how that plays out. And to reiterate, the December contract, the 55 through the 80 strikes traded with high opening percents across all of those strikes. So really an interesting, fun week. I mean, it would be great, like a 12% move in the crude. I mean, it's just nuts. And if you start to look at that kind of thing, and if you say, well, even if we get half that, right, it's still great moves. Even if you get $1.50 every day that's moving around, there's trade there. So a lot of fun stuff to watch.
Yeah, a lot of fun stuff, and people obviously have crude on the brain this week, Nick. So maybe let's indulge them with a crude-oriented futures options feedback segment.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, let's get to it. People with crude on the brain this week. Where shall we begin? Let's go in order. That's probably a good place to start, right? The beginning is a very good place to start. Isn't that what the song says? Andrew Martin wants to know, going back to what we were talking about earlier, Nick, the 60 strike. Does all that open interest on the 60 strike in WTI mean that people expect oil to blow past that level very soon? A good question. We were just talking about this, Nick. Obviously, the 60s in Jan just knocking it out of the park. About 130,000 contracts. Most of that coming on Tuesday of this week, and now a lot of that opening too, which is kind of interesting. Now, what does that mean? This is the question we get on a lot of our shows. How does open interest? How does it impact? And obviously, just straight up call open interest, the assumption is, of course, people want the underlying to rally, and that's kind of what he's assuming here as well. But of course, obviously, it depends what they're actually up to. They could be long the futures, be using that as a way to overwrite getting out at the 60 handle. So there's a lot more that goes into that type of analysis. You have to break down implied volatility levels. Of course, when vol's getting smacked across the board like this, it's kind of hard to see what the impact of one trade is when the whole skew, the whole wing is just getting crushed. But that's one place you can look. Also, where it goes up on the bid-offer spread. And some of those things, Nick, and this is your realm, so I'll let you dive into it as well. Those things are relatively straightforward in the equity options world. You can kind of help find things executing on the bid-offer spread. There's still a little bit opaque on the futures options side, which means that kind of analysis is a little bit more difficult. It's kind of hard to say, hey, they went up and they hit the bid, or they lifted the offer, or they went up mid-market, something like that, which is obviously a big part of that analysis. But when people ask you this kind of stuff, Nick, what do you typically tell them, and what can we do maybe to help shine more light on this for people in the future?
Yeah, I mean, I think you answered that partially just in terms of, maybe, selling upside in order to say that's where they're satisfied in terms of having to deliver that kind of stuff. But I would think again, just speculating and not knowing, I would think a lot of this had to do with just potential for a movement on the upside, right? And again, you got to remember, for every person that's selling it, somebody's buying it. So somebody or vice versa, if somebody's buying and then somebody's selling, so it could easily be that one person thinks, well, there's no way that's going to happen, even if the news is good, and the other person thinks, well, that's going to happen. So I think in this case, in the short-term side, since you mentioned it earlier in the show, how it's not really a volatility play, it's more of a gamma play. It was a speculation of a move, right? And something like that, when we were coming from the mid 40s, and if things got scary, okay, meaning if you started to buy these things down back on Monday, and if we go back and look on Monday and take a look at where the futures were on Monday, if I shoot over to the futures history page over here on Quick Strike, I can take a look. And on Monday, we're trading around 45, 46. So you're getting some pretty cheap stuff, especially on a 2-week option, 2-week plus option. So you figure if there's any kind of run up, you're going to make your money back fairly quickly on something like on a move up into the 50 strike. And especially depending on the type of move you have, right? If you move slowly, you're not going to appreciate so much in that option. But if you move very quickly and you get a spike in vol like we sort of saw this week, then you're going to have the chance to really trade out of those or trade against those. Now, got to keep in mind, just because you buy the 60s from a speculation standpoint potentially doesn't mean you necessarily have to get out of that strike. So you can sell something that's a little bit below the 60 because it got a better pop in premium and in volatility, and then you can spread that off. So I think on the short term, something like this was probably more on the speculation side of how much are we going to run up, and then I got them for pretty cheap. What can I get out? How can I get out of them? And again, there could be people who bought them early who get out of them that are selling them to people that are opening. So you're going to keep your open interest there, right? It's not somebody that you're not closing, somebody's opening up again, right? So you may not change your OI there, but you might just be rolling it to someone else. On the longer stuff, when we start to talk about, we mentioned, I know you mentioned the Jan contract here, but we also mentioned the 60 strike and the other contracts. On the longer stuff, I would tend to think that that's probably more anticipation of where people think we're going to go, or the opportunity to go through that. So again, unless you're, it used to be when we were in the pit, you could tell if paper was coming in and blasting a strikeout, they typically had an idea that we weren't going to go there, or if they were yanking it out of the pit, that they would think we're going to go through there. Or, again, you can't always tell. It's not always a pure strike play. They could be doing something upstairs, right? They could be, like Mark said, it could be hedgers saying, I'm comfortable getting out at this or delivering at this point, or I make plenty of profit if I have to deliver at 60, that kind of stuff. So I think it's probably a little bit of both. I think, but this week, just based on the activity and the amounts, was probably from a speculative upside side potential.
Yeah, I didn't mean to imply that I thought it was overriding. I was just trying to lay out some of the different options, pun intended. But yeah, there's definitely this week, particularly with being so near term and such an aggressive move in the underlying, you also have to factor that into the equation as well when you're looking at this stuff. And that tends to definitely favor I think it's going to rally past 60 type of mentality. So long answer to your question, Andrew, probably yes. All right, we got a comment from Kay Kamra. We were talking before about OIV and OVX and the crude volatility. She, or perhaps he, saying OVX is almost touching the July highs. And why? And then they say they expect a pullback in OVX and a subsequent pop in CL, obviously in crude oil there. So yeah, it's interesting if you haven't been following, OVX and OIV. Those OVX, of course, the VIX of USO, the ETF. OIV, the VIX of WTI. A little bit confusing, I know. But they tend to move fairly well in lockstep, again, showing how much hedging activity there is between the two products, and then also ARB activity. and they have had an interesting run. They kind of hit their peak back in February, right around the 80 level for both of those, then kind of sold off, had a little bit of a spike, like our listener mentioned back in July, back in the back up into the high 50s, 58, but that was a very brief kind of intraday, almost like a bit of an aberrant pop, if you will. And for the rest of most of the better part of the year, have been kind of vacillating in the mid 30s to low 40s range, with the exception, of course, of this week. Leading into this event, there was a lot of concern about whether this would actually come off. And so we saw vol trailing up, or I should say trending up as a result, as you see in a lot of these types of events. And once the event came to pass, it dropped off. It popped all the way up to about 54 or so, and then now is hovering, OIV and OVX hovering right around the 35 level, which is kind of back where they were before all this started. And we were kind of debating some of this on volatility views earlier today as well. I don't know. I mean, if you do get another aggressive pop in WTI, then we could certainly see vol come off. But I have a hard time seeing it getting much lower than here. We've seen a kind of these numbers, these indices have kind of set a floor around that mid-30 range. They haven't really trended much lower in spite of a lot of things going on this year in the crude markets. I'd be surprised to see these VIXs of crude trending much lower. That said, I don't know, Nick, do you watch these a lot? These aren't maybe traditionally on your radar. And you have any thoughts here for Kay?
Yeah, I don't watch the ETF so much, but I do watch the volatility, and just looking at the historicals just of the individual contracts and of the constant maturity. So if we take, I can speak to the constant maturity right now. So the January is a 15-day contract more or less, or a 13-day. The Feb is a 45-day. So what we can do is we can go look at the 30 and the 60-day constant maturity. Let me get over there for you guys. Open up the quick vol tool and take a look at the constant maturity, and there we have it. So if we look at it over the period of 2 years, right now, as of yesterday, the 30-day constant maturity, which would be just between the Jan and the Feb, is trading at like a 36 vol. The low that I see it for the last 2 years is at like a 26 vol, but really it's kind of the moving average over that period of time is much higher than that. So I think that Mark's probably right when it comes to, given all that activity and the fact that we could, because really, if we move back down to where we were, there's reason to own premium, right? If we move up through where people think we're going to go, there's reason to own premium. So I think what you see is, what you saw this week is you saw a big build up to an event, right? And that's pretty typical. You're going to see that big, and you saw the biggest jump in that front contract, right? And there's reasons. There's the Vega's less, so you're going to see a bigger pull up in the volatility numbers. You saw a pull up in the other vols as well, but it's definitely going to be more prominent in that front month. But then as that event became known and it was less mysterious, then you saw that come back out again. So, but you did get a 12% run up in the underlying, right? That happened. So you had some goodness there from owning the options, and then it came back out again. So that's really, you have to start to look at how much you got out of the premium that you owned, and then how much you gave back. But the presumption is that if you own that volatility, you're going to trade out of it at some point when you get your opportunities. And a good time a lot of the time is just before or just after that event, depending on what those numbers are going to do. But I agree with you, Mark. I think we have a little bit of room to go down. But I don't think there's a tremendous amount of room to go down. And then I know you said something about quick skew earlier. And if I look at the 30-day quick skew, I'm not seeing, let me go.
Yeah, that was a question from Joe Zen. He wanted a quick skew update for this week. I'm assuming he's talking crude. So yeah, have at it, sir. Yeah,
I think, from a 30-day, this is the constant maturity 30-day, which is really just sort of smoothing out it's not taking the Jan, it's not taking the Feb, it's taking in between for an extended period of time. I mean, the calls are still cheap and the puts are still rich. So, and it doesn't look like, it didn't feel like there's any big trend to move those out of a range that they've been trading for a period of time. I mean, over the last 2 years, let me see, what do I have my date range? The last 2 years here, the calls have been like 5%, not 5 vol, but 5% cheap to at the money. And the puts have generally been about 5% rich from 4% cheap on the calls and about 6.5% cheap or 6.5% rich on the put side. So, and that's been pretty consistent. If we look at that same thing for that same measure for the actual contracts, and let's get away from the January, since that one is kind of coming off the board more or less. If we look at the 45-day of the Feb, similar thing. The puts are still rich, and the calls are still cheap, but I think you could see that maybe tighten up a little bit if we start to look at that 30-day as a guide to where that's going to be. So maybe buying a call and selling a put here in the 25 or 20 delta range might be of some value.
All right, since we're talking crude vol, TVZ34 wants to know kind of what we were talking on earlier. He says, wants to know why such a crude vol crush this week. I kind of just pulled it up here in the quick strike. You guys can do this yourselves if you're logged in. I forgot to mention top of the show, cmegroup.com/Twio. This week in options gives you access to a lot of these tools we're talking about here. And then logging into the quick strike gives you access to more like these volatility tools. Click on that vol tool tab on the top there and then change your expiration to include. In this case, I've gone out to mid to late of next year. And you can see exactly kind of what I'm talking about here, but I'll walk you through it just the same. Kind of a weird confluence of events this week, too, because we talked for a while about crude having this premium to the puts and a discount to the calls from a skew perspective. And that still is, of course, the case. But you have this weird nature of, like we were saying on the show, this event kind of in the middle of the week that was also causing a bid up in vol. So you kind of had two things conspiring to crush vol towards the latter half of the week. First off, of course, crude is gapping up. So as they're moving up that skew chart, and again, if you look at this, you can see for yourself, you're going lower from an implied volatility perspective. So that's going to decrease your vol. At the same time, you had that kind of very near-term inflation of volatility due to this event, and I've often used the analogy of event risk being kind of like a balloon. It's filling up with vol. Then once the event happens, unless it's something completely out of the norm, that balloon's going to pop. And so you had that balloon popping on top of the fact that you're jumping up the skew like that. So that combo is kind of what resulted in what we saw here in the show this week and in crude this week, that this vol apocalypse, vol getting wiped across the board. Some of that, of course, measuring from that big spike on Wednesday. So the combo of the two really seem to conspire against long vol holders out there in crude. Hopefully the underlying gap made it up for you out there if you were indeed long some vol this week. Interesting stuff. Anything to add there, Mr. Nick, here as we wrap up our futures options feedback?
No, I think that makes sense. The big thing is the event vol, and there is an event vol tool available in one of the subscription versions of Quick Strike. So if you have any questions about that, you can tweet at us or shoot us an email at support, and I could talk to you about that. But that's really what we were. And the only way that vol was going to stay where it was is if we really got that run through the 60 strike, because then you're really talking about some potential activity, because not only do you have room for more on the upside because you've gone through some barriers, but you also have the possibility of moving back down to where you were. So, there would have been continued expectation there from a volatility level. And you could probably go back to some of the bean shows that we talked about where, that vol stayed up with these movements, with these kind of big spikes. But I think since we don't have much on the horizon here, or it'll take some time before we see some of these oil producers actually adhering or not adhering to what was agreed upon during the meetings, we may not necessarily see anything until people start looking at talking about technicals and where we should be and getting some more EIA numbers and that type of stuff.
All right, Nick, that theme, the return of that awesome theme. We should play out throughout the whole show on the bed. That'd be kind of fun. It'd be distracting though for us and the listeners because it's just too cool. But that theme means we have come to the end of yet another epic journey. This is the first time I think we've ever done this where we focus exclusively on one product for the entire show. But then again, there was a lot to talk about this week. So certainly you guys had some questions about it as well. So certainly everybody had crude and crude vol on the brain this week. But before we go, Mr. Nick, you guys are always cranking out new updates, new tools, new features for all things over there at Quick Strike. So what can our listeners look forward to next week?
Next week. Well, I think the bigger news this weekend is that if you are a CME Direct user, there is going to be even more ease of use and more available with the Quick Strike through CME Direct. So you can add a button on each strike line and you'll pop open to a quick strike window that will focus on that particular strike, and then also give you all of the information about the expiration associated with that strike. So if you are using already, take a closer look. If you aren't using, maybe figure out a way to get that installed for yourself on your desktop, because that's it's got everything that we talk about here is available there, and it's available in a very it's got much more available than in the free version. As far as the stuff that we have going on, got a new build going out this weekend, so there'll be some interesting changes and integrations there, more for ease of use type of things. So we've merged some information into different pages, and then as far as the this week in options report, we now have on the intraday, on the current day's volume column, we are now showing whether that volume comes from Globex, a block trade, or the floor. So you'll be able to see where the activity is there. So it's I think that'll be cool when you start to look at, especially take a look at the crude this week, and you can see where a lot of there was a lot of activity, and a lot of that 60 strike came from the block market this week. So that's always good to know, right? Because then that's like some maybe bigger players out there as well.
Yeah, the big block traders trading in the 60s. Everybody and the mother trading in the 60s this week. That was the strike du jour across the board here, Nick. Well, thank you for that, Nick, and thank you to you guys for joining us yet again. Another week of TWIFO this week in futures options. If you missed a live show, don't worry. You can come on in after the fact, wherever you get our favorite programs, including, of course, via the main network feed, probably the easiest way to get all of it. iTunes, Stitcher, our website, etc. It all comes out Monday morning. You know where to find it. And on behalf of Nick and indeed myself, I want to thank all of you out there listening audience for downloading, streaming, and subscribing. And of course, for sending in such great and fun and many and varied questions and comments. Keep those coming. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.